to our special series, Hedge Fund Corner. Joining us today is Raju Kamath, CEO of Kuvera Capital from London. The Kuvera Fund is an India specialist hedge fund, and its strategies include India long short and mid cap. Let's head straight across to get more insights on Kuvera Fund's strategy. Thank you so much, Mr. Kamath, for joining us here at Bloomberg TV India. Tell us about what really is the strategy behind your fund, and how do you go about picking those stocks in the Indian market?
Broadly, as you said, we attempt to be a hedge fund, so we are long and we are short. The typical portfolio has about 80 stocks in it. It's about 60 long, 20 short. In terms of our exposures, we run an average net exposure when we're very bullish up to about 70%, and we go down to about 20%, though we have been net short the market. In terms of how we actually pick the stocks in India, it's very thematic, and what goes into that is basically a global macro view, because India is very affected by the global markets and global liquidity. And also, once we establish that, we then look to take a more bottom-up or a more fundamental approach once we actually establish where we think the risk dial should be with regard to India.
All right. In the last 1 year, Mr. Kamath, if you were to see, there's much run-up that we have seen with the Indian equity markets. What do you think really were the key themes that were emerging? And do you think that strategy or those themes still continue to exist as we head into this another year after the new government and the hope wave really now not simmering down, if I may say so?
I think last year actually it was quite easy to pick. I think last year the theme was a new government with an overwhelming majority and a mandate to do what it needed to do, which essentially was reforms and encouraging investment. So I think actually what happened last year, I think the market tended to trade unfundamentally. So we had a lot of underperforming stocks post the election of the Modi government that started to outperform. For example, PSU banks, capital goods, which had been underperformers before, I think, based fundamentally. But based on the expectations of what the Modi government would bring in, I think those sectors and those stocks began to run ahead. And the more defensive themes, such as pharma, where we were long, underperformed relatively. I think post the euphoria and the last earnings season, I think the market is beginning to focus much more on earnings and fundamentals. And so you're seeing the performance now, I think, based much more on earnings, and yet to be seen whether the reforms are going to be put through in the speed that the market has anticipated. So I think in summary, the market ran away last year based on expectation, as it did in 2004. And now I think the market's taking a view and looking to see whether the implementation will actually happen, which I think it will, but over what time period. So that was relatively difficult for us last year because our short positions, which were in PSU banks, ran up against us. In anticipation of that, we began to cut those short positions and just open the portfolio up. So we were running a net long of about on average net long of about 65%, and cutting our shorts in the underperforming sectors. What we've done post-December is to re-establish the portfolio based on a more fundamental rather than a liquidity-driven or expectation theme. And we've reinitiated shorts, for example, in public sector banks, stocks specifically in some capital goods names. And the portfolio just has become much more fundamental again, rather than just avoiding the liquidity that was coming in.
You mentioned that you're short as far as the PSU banks are concerned. Do the concerns of with regard to the non-performing assets come into play, and you're long on private sector banks? Could you help us understand your strategy behind that?
Yeah, basically it's very simple in terms of the short. I think as you touched upon, the NPAs are a big issue for public sector banks, and allied to that is the fact that there's going to have to be capital injection into these banks. And I don't think that the market, I mean, we have seen some research notes comes out saying that the NPAs aren't going to be as bad as we thought, but we don't buy that. And if you look at the growth between the public and private sector banks, the private sector banks are increasing market share. I think the number in terms of revenues is somewhere around 50% now. So the theme really is that the public sector banks are waiting for capital infusion. I don't think the NPAs have actually hit the balance sheet as yet. And they look very cheap on a price to book, but I think there's a reason for that. Contrast this, I think, with the private sector banks, which have much higher ROEs, much lower NPAs, and don't require capital infusion or a large, significant capital infusion. So I think that's very simply, it's not very complicated, the thinking behind being long private sector banks versus a short on public sector banks. And I think also for the economy to actually get going, public sector banks need to be able to lend again. And so the capital infusion is going to be quite critical. How that happens, whether it's via a holding company structure or, and at what conditions the government put on it are yet to be seen. But that thesis, in our view, still holds true.
Let me come to the pharma sector. You mentioned that, I mean, your portfolio looks long as far as Sun Pharma and Lupin is concerned. There have been concerns around Sun Pharma lately that we have seen, and do you see that to continue?
Well, actually, we are along a basket of pharma stocks. Our kind of long core picks are Sun and Lupin. And the thesis behind that really is the growth of the American market and the underpenetration that Indian pharma companies have there. And we saw sort of a patent cliff happening a few years ago, and that's continuing to happen. Specifically with regard to Sun Pharma, the company came out with a statement yesterday saying that they were going to miss their earnings target. We briefly reviewed that. It's not a position that we will be looking to cut. In fact, it's something that we may be looking to add to, albeit the earnings growth will have to come probably a year hence. But it's been performing very well up until now, especially with its subsidiary in the American market. It was trading at a premium, but the premium, I think, was justified because of the earnings growth that we saw. I think the acquisition of Ranbaxy has basically impacted that. But the management also came out with some positives in terms of getting their facilities up to speed as regarding the FDA are concerned, and also some more synergies with regard to integrating Ranbaxy. That's a much longer term play, but we are still comfortable with those long positions. And we, as I say, we hold that as a basket of pharma stocks in any case. So we don't have an overly large exposure to it.
You're long on auto sector, and what is it that is exciting you about it? We've seen the entire run-up as far as Maruti is concerned, and of course Tata Motors. What is it that is exciting you?
Well, in the auto space, it's really those two names that we are long. In terms of Maruti, we took that position probably over a year ago, where we thought the valuations were cheap. I think the reach Maruti has in the Indian market is really unparalleled, and the competition in the small segment space as well is really not there. So for those reasons, and taking the position out where we thought there was value to be had, was really what drove that pick. In addition to which, you're seeing a weak Japanese yen, which is also helping in terms of the earnings. And I read just this morning before coming into your studios here that I think Maruti is overtaking its parent company in terms of, I think it's either market cap or revenues, which just shows the impact that Maruti does have in the Indian market. We still find their value to be there. In terms of Tata Motors, I think the story is slightly different in as much as the earnings growth is going to come from its Jaguar Land Rover subsidiary that it bought, I think, post the financial crisis. And relocating a lot of the production now, some of the production to China, I think is going to be a positive for it, and that's where the earnings have come from. And we still continue to hold on to that thesis. We see nothing's changed in terms of that. We're seeing some unraveling of the Chinese stock market, but as far as our position, we're quite happy to be long. In terms of the other auto, maybe two-wheelers more specifically, we have no positions in there, but we don't have the conviction to be short, which we are looking at. We're reviewing whether we do need to go short, but the earnings volatility is just too much for us to actually understand at the moment.
But how do you see the IT space coming along? HCL Technologies is what you're betting on.
Yeah, the IT space recently has been quite a difficult one for us to understand. We see the premium that TCS has had over its both Infosys and Wipro, and it's been and our bet really was that we had a long position in TCS which we sold out of. Because we thought there was going to be earnings convergence between both Wipro and Infosys. And that is, I think, is just beginning to play out now. So maybe we entered that trade a bit too early. So in terms of relative valuations in the top three, that's kind of been a bit difficult for us. In terms of HCL Tech, which is a core long position for us, I think that's been a lot easier, just because its earnings growth is coming through. It's continued to deliver earnings growth. It's diversifying its income streams, and it's trading very simply at a discount to the big four, and it continues to trade at that discount despite the earnings growth coming in. So that's been the reason that we've been, for a long period of time, long HCL Technologies.
And what is the concern that you have for being short as far as Kane is concerned? The reason that I'm asking is that is it because of the overall issues in the oil and gas sector, or is it specific to the way the entire Kane India story is unfolding? Actually,
it's a combination of two things. We had been long Kane, and we were expecting volume growth to come through, and that really hasn't happened. Also, I think, is the added concern of what it's doing with its surplus cash. And given our view on oil prices, added to which the sort of fundamentals related to Cairn particularly, it became a relatively easy short for us. So I think it's a combination both of where we see oil prices, given what Saudi Arabia now, what Iran is coming on stream, and also what's happening with the shale gas industry in the US with regard to the leverage they have. I think the short in Cairn was a combination of that, added to the specific concerns we had to do with the company.
You've mentioned as far as being long on cement sector, and what is it that is making you bet for it?
Well, I think we've probably been a bit early on the cement sector. We haven't got the timing right on that. But the thesis behind that is we're basically looking to take advantage of the reforms as they come online, and we see cement as a good way to play that for three main reasons, really. One is the capacity that's coming online now is less than has come on recently. So capacity coming online is falling. Utilization rates are increasing. And also we see input costs falling as well. So those are the broad strands why we've gone long cement. And added to which we're hoping for the reforms to come through and cement to be a play on that. As I say, we haven't quite got the timing right yet, but we continue to remain long a basket of cement stocks for those four reasons.
All right, my last but not the least, I want to understand from you, as far as the domestic factors are concerned, how do you see the India story really unfolding in the coming few days?
I think in terms of the domestic factor, as I said at the beginning of the interview, I think you can't unravel that from the global factors. So I think before you look at the domestic factors, you have to understand the global kind of backdrop and where India fits into that. But once you understand that and you get into the domestic factors, I think one thing that's going to be key is although it's been hashed by many people, is going to be one, the intent of reforms, and two, the speed of reforms. I think the market ran up last year based on an expectation that these would be implemented pretty quickly and across a raft of sectors. So I think it's now attendant upon the government to actually deliver those reforms. I think in terms of other risks in the domestic space, I think that we're going to have to. I think reforms are basically going to be the key thing that drives it. I think corporate governance, I know SEBI are doing a lot with regard to that, is also going to be not as major a factor, but definitely a factor that investors are going to look at when they come back to the market. So I think, but underlying I think without reforms, I think the market really doesn't really go forward.
All right. Thank you so much, Mr. Kamath, for joining us here at Bloomberg TV India, and appreciate your time with us and sharing your investment mantras. Thank you so much once again. Well, that's it from my end, and news and updates continue on the other side.